This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is see you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collecting trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode is with someone who has experienced the growth and evolution of the credit space from a number of different vantage points. We welcome Alona Gornick, a managing director, senior investment strategist, and co-head of the Chicago office for Churchill Asset Management, a $50 billion AUM provider of financing solutions to middle market private equity firms and their portfolio companies. Churchill is an investment specialist of Nuveen, the asset manager of TIAA. Alona provides investment insights across the private capital spectrum, the investment community, and has a particular focus on working with the private wealth and retail channels. She worked closely with Nuveen's global distribution team to deepen relationships with and educate Churchill's investors and partners. Alona leverages her experience in capital markets, investor relations, and credit investing from working at the likes of Nuveen, Golden Gate Capital, and Oaktree Capital Management over 14 years. Alona and I had a fantastic conversation. We discussed the evolution of credit investing, the opportunities and risks in private credit, whether or not we're in a private credit bubble, why the specialist role is critical to working with the wealth channel, the power of scale, particularly in private credit, and how it helps alternative asset managers win deals and invest, and the strategic benefits of platforms and permanent capital. Thanks, Alona, for coming on the show to share your views and wisdom on private markets. We hope you enjoy.
Collision of culture and finance.
We're going mainstream.
Alona, welcome to the Altco's Mainstream podcast.
Thanks so much for having me.
Pleasure to have you. You have a fascinating career trajectory. You are in a space that seems to be at the tip of everybody's tongue, private credit. You also do public credit. So I think we have a bunch of interesting things to talk about today. First, I'd love to start with your career path that took you to Churchill today.
Well, first of all, thanks so much for having me on the show. Really feel honored to be here. Today, I am a managing director and senior investment strategist at Churchill. We are one of the leading private capital platforms focused on that core middle market in the US. But I'd say, given we're in the back to school season, my little sign did not have what I want to be when I grow up is a middle market direct lender. I had no clue what that was coming out of college. I'm really thankful, though, for all the twists and turns I've had. Thinking about the better part of the last 20 years has been in credit investing, first half in the public side, second half really on that private side. So I have been able to see the investment environment through low rate environments, high rate environments, and everything in between. But I'll say there's 3 stops that I had before getting to Churchill. First one at Bank of America before it paired up with Merrill Lynch in investment banking. Got a sense of how to pitch, structure, and even sell a deal to the institutional market. So that a sense of what are the capital markets really like pre-crisis. And then high yield bond investing, my public side days at Oaktree, phenomenal firm, pre GFC days. So spreads were tight. The deals were drive-by in nature. Your goal was to beat the benchmark. So really different in terms of an investment mindset, but definitely great to get out of the sell side and onto the buy side. And then I found my way to TIAA, which is Churchill's parent company, and found a role in private placement debt, which is a really interesting way to go to the high grade part of the market, but work with companies that are for the most part private, but some public companies that choose to do deals privately. And I thought, wow, this is really interesting. I have more time to spend on this deal. It's not a 2-week drive-by. I can decide whether or not I want to do it not on the basis of a benchmark. And price discovery took a little bit more. There weren't a ton of data points. You really needed to kind of come up with that. And while I was at TIAA, the opportunity came up to learn a little bit more about Churchill because TIA through Nuveen acquired or affiliated with Churchill in 2015. And I definitely raised my hand to find out what that was. As I said, I did not know what middle market direct lending was. So I meet the founders of Churchill and I thought, wow, these guys are great. They're super passionate. They've been doing this for a really long time. And for me, it's always been about the people. I want to learn, I want to grow, I want to find great opportunities, but something about this founding team and what was ahead of them, I did not necessarily follow a trajectory of an arc of alts. I was sort of like finding the best way to see where can I learn, where can I grow, and where can I add value. And when I raised my hand to do this with Churchill, they said, Alona, we love you. You've got this. Let's do this together. So I never looked back, and it's been 8 years. And I just feel so grateful for the opportunity to have been on this train with them, and they've grown like a rocket ship.
Well, it's fascinating you say that middle market direct lending would not have been on your career path when you were writing what you want to be when you grow up. But I think it's fascinating to think about that in the context of middle market direct lending. It has grown in size and scale as part of a much larger and growing private credit universe. You've seen evolution of credit over a number of years, pre-GFC, post-GFC, and obviously the current golden age of private credit as we're in, according to some, certainly a growth into the space. What has been the biggest difference in the world of credit from when you started to today?
I'd say many things in terms of if I was just looking at public versus private. But if we stay with where I am now focused and just think about private, I'd say biggest changes for me that I've noticed over the last 8-10 years has been the size of the private capital managers, the size of capital that we have at our disposal. The underlying business of what you actually do, sourcing through relationship-driven opportunities, isn't really that different. You don't find these deals on a Bloomberg screen. Your relationships matter, and it's not about who you know in the business or who you worked with a long time ago. It's about who wants to do a deal with you. And that may mean having to take some at-bats and try things out and maybe even get closer if you guys go through a tough time together. So I'd say that part of it hasn't necessarily changed, but really biggest differences I've noticed is size, scale, and then certainly I'd say second, the number of managers. There just seem to be so many more names that I quite honestly haven't heard of. And in the part of the market we're focused on, we actually don't run into a lot when it comes to our real deal flow. But as an investor, I can imagine it's overwhelming because you see so many managers, but you don't realize they're actually not in the same types of deals with one another. We're not even competing with the same deals. I guess finally, the way you access the space, it has historically been institutionally focused drawdown lockup funds with very high minimum to get in. So that's definitely changed to be a lot more accessible and really tap a very huge potential market, which you've talked about, the wealth side, which is just trying to get where institutional has been and spent so much time getting from single-digit % allocations to alts and even private credit. To even get that to double to 6 or 8 is a huge amount of effort. So I think we're really trying to be more accessible to that part of the market.
Certainly want to touch on that because I think the way in which you service the wealth channel is so important, and also the evolution of your career terms of how you're working with the wealth channel, I think is also fascinating for people to hear about. But before we get to that, you mentioned size and scale of platform. At Churchill, you are part of a bigger platform in a few different ways, both with Nuveen and with TIAA, and not to mention Churchill's, 45 billion or so. So a big platform itself. How much do you think size and scale matter in the universe of private credit?
I think that size and scale matter a lot. It is a really big differentiator, particularly where you are focused. It doesn't need to be everything, but from what we've experienced at Churchill, my early days in 15 and 16 when the platform got started and the checks that we were able to write then, and as an originator knocking on the door of private equity firms with, hey, we can do 15, 20 million in your deal. And they'd be like, great, thanks, Alona. We actually need 150. So, we're going to call around and see who else can kind of help us make this deal happen. But thank you. We really appreciate your thoughtfulness. To when that doubled to 50 or 60, I was like, yes, I'm over 50. And I'm a little bit more meaningful in this club of you're looking to get to 150. So yeah, come on, take my check. That's great. Conversations got started earlier. I wanted the phone calls earlier. But when I could finally say 100 million, and at that time, I want to say 18, 19, there weren't that many in the core middle market that could do 100 million that were focused on this part of the market. That was a big deal. And soon that handful became two handfuls that could do 100 million. And if you didn't have that, you were absolutely not going to be in the discussion. Because ultimately, if the financing is 150, 200, or 300 million in size in the part of the market we're focused, this traditional core segment, and you're really only talking to a few lenders who can each do 100, there's only 3 or 5 of you that get into that deal. So if you're the 7th or 8th or 9th phone call, you're probably not in the deal whatsoever. So scale is so important to have that early call be meaningful to the deal and really often lead you to being able to lead the deal, be the agent, control your destiny, be in the driver's seat to negotiate the credit agreement, the terms, the spread, and ultimately really influence your allocation in the deal. You want more than 50% of it if you're the lead, but you don't always even get that. You'll pitch the whole deal and you make it allocated down. And that's tough. So scale, when you can bring it, is enormous when you can combine that with experience, thoughtfulness, efficient questions, efficient turndowns, the ability to support incremental financing. So even if they don't use your scale, your dry powder today, the private equity firm's thinking, well, I'm going to save that because I have a highly acquisitive strategy here and I want you in my deal because you can grow with me. So I think scale helps tremendously in the part of the market that you're in. And if you use it wisely and you know why you're in that part of the market, your swim lane, you can really use it to your advantage.
So a few really interesting things to unpack in there. One is you mentioned how scale enables you to come with more capital and make a deal simpler for the sponsor because you can be their one-stop shop capital provider. How do you think things have evolved in the context of deal structuring from maybe more syndicated deals in the past to one single firm doing a deal? And how does that look going forward in terms of who's the provider of credit to some of these deals?
Generally, I think that the demand is really being driven by the private equity firm, typically for us, because we're looking at all sponsor-backed deals, but the owner of the business and what makes their life easier. What problem are you trying to help them solve? And if that is to buy and control this asset and do it in a competitive market where 20 other private equity firms are looking at this asset, what can you as a debt partner to me help me make this easier? If you're telling me you can only do the senior and I have to bring in a junior tranche, and then there's a 3-way deal and we all have to get on the same page, plus an intercreditor in between, there's a lot of negotiation there that's going to slow down the process. So this evolution to fill in the demand of how do you make my life easier comes through and is demonstrated by unitranche type structures where you can combine a senior junior into one credit agreement, you blend your pricing together. I think that's an evolution of the market that's certainly here to stay in terms of efficiency. But other areas of creative solutions, particularly in the rate environment we're in, that have really emerged is how do you make my life easier and that I do want to borrow this debt, but it is extremely expensive. And this business, I'm trying to grow it. It doesn't have that much true cash flow generation today, but it's a great business. We're going to optimize a lot of the OpEx that's there. We're going to expand and maybe do some price increases to help bring in, amplify the revenue and really expand these margins. But it's going to happen. It's not yet there, but we're going to work on this. So can you help me with a solution financing wise that has some cash and maybe some pay in kind today? So either a PIK feature that's blended or even a full-on tranche that's a holdco PIK solution that's all PIK. And it helps lower the cost of capital from a cash perspective and also help that private equity firm's idea of what are my returns in the future if I don't have to use all equity from my fund? Can I have help from you as a lending partner in some other way? So I do think there's some evolution out of demand here, given the high rate environment we're in, to see. Now, will that be forever? I think when things moderate with rates, maybe that not necessarily comes out of favor, but less in demand, but is an interesting evolution.
Is the influx of capital into private credit going to change how firms look to structure deals, how they think about their underwriting standards and the competitiveness around that, kind of maybe loosening some of those underwriting standards?
I think overall, when you say returns in private credit, I think it's still important to remember it's a really compelling time for private credit. If you think about the basic structure, it is a base rate, the secured overnight financing rate. Floating on top of that is a spread. And then you're typically booking these deals at a discount because you come in at the beginning, you're meant to hold it for the life of the term loan, and then you hopefully get out at maturity at par. As you think about the components of the yield, that base rate is elevated, now 500 plus basis points. It's been there for the better part of the last 18 months or so. It's probably going to come down. Spreads have generally been somewhat resilient. I'd say there's been compression from the wides we saw last year and 18 months ago. That's not out of the norm. We expected that, but there's been increased compression, I'd say, in the current market we're in. As you mentioned, competitive dynamics are bringing in more capital. There's a lot of focus on the deals that actually transact today, high quality deals. You don't want to miss that deal. So what are you willing to do to get that deal done? Are you willing and comfortable in the trade-off that this whole thing requires to go a little tighter on pricing? And so it starts to drive that spread compression even tighter than where we were before. But if you think about the all-in yields at that historically, call it 6-9 months ago, we were 11, 12%, now coming down to 10, 11. And then in the future, not too distant from now, we're probably going to get out to 200 basis points tighter than where we are from a base rate perspective. You're going to see that kind of maybe be 8, 9. That's still compelling as an all-in yield from a return perspective. If you remember your senior secured, first in line of repayment, top of the capital structure, if you're getting that kind of yield, I'm still happy about the return picture. But from an underwriting perspective, what are you willing to do to get that deal done in a more competitive environment? I think that's been an interesting development right now. Outside of the spread compression, which is a natural thing to look at when you want to get more competitive and win a deal, there are other elements that lenders can use or tools to try to make it more attractive for them to get into that deal. And if that's to offer a looser covenant package or no covenant or higher leverage, what can you do to meet that demand, solve that problem? And if you're willing to take it because you need to, because you want to, because you have capital coming in 4 weeks from now and you can't afford to say no, I don't want to suggest that's a compromise of an underwriting standard, but I think it's just a trade-off that each manager needs to make on every single deal. And if you have far more deals in your pipeline that you can look at, you are going to be fine to walk away from that deal. You're going to be fine to say, I'm okay, I don't need to go there. And you want both quantity and quality on that pipeline. That's going to be so important. So I think, yes, I could see some, not full compromise, but some changes, not necessarily in underwriting, but just deal structuring, I think is probably going to be most in focus right now. Underwriting standards are definitely based upon that manager's experience. If you haven't lived through the crisis in terms of investing in direct lending, it's very hard to understand what did the environment look like in high rates and low rate environments. And how did you pick and choose the winners at that point in time? What is your worst case scenario if you've never lived through that, investing in it? It's very hard to sort of build into your downside case truly. And more importantly than that, what private equity firms, if you haven't done this for a long time, have actually been good actors in times of stress? I think that's a completely fascinating part about that experience or lack of experience in the space, which is if you're going to partner up with a private equity firm for a long period of time in this deal, and it's your first deal with them, you really don't know how they'll act and how supportive they're going to be, even if you structure this deal in a great way. So underwriting that firm is as important, maybe even more important than just the underwriting or the deal structuring itself. So I do think there's a lot of things to take into account when you think about competition, capital coming into the market, but can you walk away from the deal and have the discipline's the biggest thing.
So you're in a really interesting seat right now in terms of interfacing with investors and hearing their feedback. What are some of the questions they're asking you?
Oh, the 60 minutes I have with them is kind of like a pop quiz. There's no prepared agenda. I try to figure it out beforehand on any of these calls, but the common questions I'm getting, I'll tell you, and it really depends on the three buckets I put an advisor in. You're either in the early stage, I'm not really sure about private credit. It's if, not when for me. So that's like a very basic education type of conversation.
On that point, why is it if?
So on the if, not when, the biggest questions for those folks will be, I'm very comfortable with my 60-40 model. I'm getting a lot out of cash today. Why do I take on more risk and what sounds like illiquidity when I really want psychologically that comfort of what I know, which is I can get in, I can get out. There's broad diversification across the managers I can choose from, the sectors, the geographies. I'm perfectly fine with that. Something in alts or private credit for that matter that sounds scary to me because I don't think it's lived through a crisis or I don't think it's proven its worth yet. So I think it's more just the if is that they haven't yet spent time understanding the space, right? Understanding how long-standing the asset class has actually been. So it's a very big focus on just getting you comfortable with what is it. And it often involves, we now need to get on a second call. If you're in my second category, because that's probably the second or third call I have with you, it's okay, I like the private credit. I like what you're saying. It makes sense. I want to do this. But now it's how, with who, but how many of you? Like, what do I do? Do I do one of these managers? Because I have 20 to choose from. So how do I do it? And that's a different type of conversation. Biggest questions there are, is the space too crowded? And too much capital chasing too few deals? And I love the questions at this category. There will be, what about defaults? I'm seeing a pickup in defaults. What's around the corner? How will private credit fare if we do have a soft or harder landing? What's that going to look like for me? And then third is, if I'm going to do it now, and I've seen all this growth in private credit, is that going to stop or is that going to slow down? Have I maybe missed it? I want to think about that. Am I getting in too late or is this the wrong time? I think there's some really interesting questions you spend time on there, and they're still maybe not yet convinced.
Rates may come down. Looks like they likely will, at least a little bit. If that happens, is this still the right time for private credit or is there not a right time for private credit?
The way we think about it, because rates are out of our control, is it is more an opportunity to think about the yield premium. Always think about it relative to where else your portfolio sits. And do you think that that premium is worth it to you if you understand what you're actually getting in terms of the exposure? The biggest positive or benefit attributes I think are resonating are this huge piece about increased diversification in my portfolio because of private credit. My portfolio will do different things now that that's in there. It's low to negative correlation to what I always have in there, which is fixed income typically. So that's going to be positive for me. But the premium I'm getting off of private credit versus if I were more comfortable with public, broadly syndicated loans, that premiums generally live between 150 to 250 basis points, but call it on average about 200 basis points, moving a little bit here and there. That certainly is going to be great even when rates do come back down. That generally will be an attractive all-in yield that you'll have when everything else is lower as well. And you're still going to get the benefit of being senior secured, top of the capital structure in that yield premium position, which if you remember, rewind the tape, that's really what fueled a lot of the private credit growth after the crisis, which is a search for yield. And now we're in a completely different place. We don't have a search for yield right now, but what we do have is a massively untapped investor base where the whole time for those last 13 years was spent on the institutional side getting up and running is now wealth side, their turn.
On that point, how much do you have to spend time educating the wealth channel on where they take this from the asset allocation bucket? And maybe we can even argue that the way one configures a portfolio has changed too. So maybe even thinking about portfolio construction is a little bit different. But how are a lot of the allocators you're talking to in the wealth space thinking about where they place private credit?
It is one of the questions that does come up often when we do get past the if not when, the yes, I want to do it. And they're like, okay, I'm ready to begin, but where do I take it from? And it's a mix, but I'd say the majority of folks feel most comfortable or seem to make the most sense for them when they're thinking about pivoting out of fixed income, given that they think about it as a fixed income-like type of exposure with that yield premium to it, but that consistency of getting current income is sort of the feature they like about the fixed income. So I think most folks are pivoting out of there, but I like to refer to private credit, particularly direct lending, as a bit of a chameleon. And then I have had some conversations where if folks are already doing alts and they have private equity, because that's often a go-to. Once you want to do alts, you want to go all the way. You want to do private equity. But they have a view on how private equity returns may look in the future. And maybe there's some concern of potentially on that part of the advisor, how great they'll be. Could private credit be a way to maybe de-risk a little bit private equity where you're getting exposure to that underlying business, like a private equity backed business, but you're doing it in the form of private debt. So it's a really unique way to kind of get exposure, but maybe move up in the capital structure. So that happens from time to time, but it's mostly fixed income. It's largely where I see folks thinking about pivoting from.
Which is also interesting because you have a background in both public credit investing, private credit investing, and I should note, you were also an investor before now being a product specialist. So how do you think your role as an investor, both across the public and private credit spectrums, have now helped you talk to the advisor channel and investors as a product specialist?
I'd say it's helped tremendously. Just set aside credibility that it should hopefully bring. I think first and foremost, I'd say being a credit investor just outright makes me someone who tends to be very downside focused, like what can go wrong, as that's naturally who I am. And when I approach a conversation with an advisor who's looking to learn about the asset class, learn about Churchill, learn about our strategy, I generally can't help myself but provide a really balanced view and offer not only what's great about it, but what I would be concerned about. I want to offer the risks and the benefits all together. I can't leave that discussion without giving a completely holistic view of it. And I do it purely from a place that comes across as authentically educating and not selling. And that's just generally who I am. So I do think that helps a lot with having that credit investing mindset. But second, I'd say I feel like I can really relate to folks when I can give examples to make it real. So to draw upon deals that I've worked on or deals that maybe I thought weren't going to go well, but then it turned around and really give it some life. And I'll try to find something in that advisor's neighborhood where they live or any clients that they have that are maybe certain business owners in certain industries. I'll tap into my memory bank of what I've worked on that may be relevant for them and easy to understand. And it makes it a lot more of an informed discussion that I really promise them I'm not going to make them an expert in private credit in the next 60 minutes, but I will help you have a more informed discussion. And hopefully it's with me and you'll ask better questions the next time. If education leads to allocation, and I think that you guys talked about this on a last podcast, you've got to have a willing participant that's ready to learn, that wants to hear what you're saying. And that's about being open-minded and being able to trust the person. And then on the other side, the educator has to really come through with more than just the selling points, more than just like the 5 bullets they memorize. It's really compelling when they actually can give you true stories of living through something. And I think that makes the allocator or the advisor more confident to be able to share that story with their client. Because it's all about the stories, and they need to be able to own that story and tell it in their version.
You're hitting on a hot button issue on Alt Goes Mainstream, and I've had varying viewpoints. Maybe not surprisingly, those who have been at alternative asset managers would say one viewpoint, and those who've been at traditional asset managers but now are building out alt capabilities or distributing alts may say the other. And there's everything in between. But given that you have kind of both perspectives in the context of Churchill being part of a larger traditional asset management platform, Nuveen, but also you came from Oaktree, which is an alternative asset manager, who do you think will ultimately end up winning? Will it be alternative asset managers because that is their background, brand, and DNA? Or will it be traditional asset managers who are able to bring in experienced people like you as product specialists who can help the distributors who have these great relationships, have the connections with the RIAs and the wealth channel, actually distribute the product because you're the specialist?
Oh, that's a tough question. I'd love to say we can all win. Everyone gets the gold medal on the podium. And I honestly mean that I do think the space is large enough to have winners on both sides of how you're made up. But if I were to give you an answer, a true honest answer of what I think could cause failure, because I don't know if there's like a full on who wins what. But what could be a stumbling block, in my opinion, is if you have issues with access to capital. I think that's a really important piece of this, which is when I say you being the manager, do you have unfettered access to capital at all times, regardless of what market we're in? And I'll give you our example where we're ultimately owned by TIAA, a not-for-profit, not publicly traded company that doesn't have to rely on the public equity market for follow-ons to get access to capital to then help us out if we were in a time of need. They have an amazing general account. It's enormous, and it continues growing regardless of where the market is. So that's an incredible safety net, and it gives you a ton of flexibility as a manager, a boutique manager, or alts-focused manager inside of having that relationship. So that's huge. And with that, we're doing it shelled inside of what feels and looks like more of a traditional manager. So we've had to mold into that. But I do think structurally, where's your capital coming from is probably more what I'm focused on with winners and losers on this and how you can get to the market. But if you are fully publicly traded, you have a great brand, this is fantastic. If you are only relying on the equity and debt capital markets that could be open or shut at any point in time, certainly along the way, hopefully you've created great relationships with massive limited partners and your funds, and you can have access to capital that way. I think there's ways to solve around that capital, but that's the capital side. From a distribution perspective, could you do it wrong? I do think that there are mistakes people can make. And the way that you bring the subject matter expert or product specialist in or not, regardless of whether or not you decide to do it, I think you'll fall down if you just don't get quality people. I think it's all about hiring the right people. I'm really thinking about the types of people that maybe don't have traditional backgrounds in what you're looking for, but they're going to be excellent at what you're needing them to do. And if you hire way too many of the unqualified, where it's just to hire bodies, you're going to have to constantly deal with turnover and re-ramping and re-educating. And it's a big distraction. And that won't look well. That'll be very difficult to get something off the ground, whether you are alts only or traditional doing alts. I think it is about the people.
What are some of those more non-traditional backgrounds?
I'd say my background is a little non-traditional in terms of coming into the specialist role. I know I didn't have middle market direct lender on my what I want to be when I grow up. I certainly didn't spend all this time on the investment side, underwriting deals, cutting my teeth, late nights, going to business school. Not saying that you can't do this and then be an investor focused person, but I didn't know I was going to be here. And now I absolutely love it. I think this fulfillment is in such a different way for me to have the person across the Zoom or the table from me have an aha moment. Like what you just said really makes sense. And I think I want to invest. It is very satisfying for someone to tell me that was the best version of explaining private credit I've ever heard. But if I was talking about a deal to committee, no one tells me, Alona, you did a great job walking through that deal. That was spot on. Maybe they do, but so it's a different level of fulfillment. I think my background is not as traditional, but maybe folks that have an entrepreneurial background, I'd say, thinking about building businesses, thinking about really putting yourself in the other person's shoes, anyone that's ever had to raise capital, those are really tough roles to be in. And if you're passionate about learning, I think that is also going to be someone who's great in a role like this. And I'd say, biggest thing I take from my previous role to now is being willing to deal with tough situations. As an originator, I was constantly turning deals down, and that's a very tough conversation to have. If you were as selective as Churchill is, we turn down about 8 to 9 out of 10 deals we see. So I'm a breakup specialist. If you can do that and manage to get them to tell you about the 11th deal, that's a pretty amazing dance on your feet kind of role to play. If you can do that, you can really find great people in sales or specialist roles.
It's so fascinating to think about what it's going to take to really continue to upskill this industry. When it comes to educating, because you are on the front lines of doing this with so many different investors, what do you think are the most important things to think about when educating investors on private credit?
I'd say really for the educator or the specialist, it's really about having certainly patience. You want to be able to meet that advisor or the investor where they are. And you don't want to talk over them or around them, get too technical, because you'll spend that 60 minutes and it would have been a waste of time. Then all this great information you shared with them was just too soon. So you need to meet them where they are. If they're early in the journey of learning about private credit, then you've got to go there. And you have to be able to pivot on a dime because you don't know. And oftentimes they don't share with you when you start the conversation. You might ask, well, how much have you know about private? They'll hold that very close to the vest. You really have to be a bit of a detective. Take a pause, ask them if they understand what you're saying or does that make sense along the way so you can reset and really meet them where they are. Your goal isn't necessarily to sell them right now. It is to get another conversation with them going. And of all the private credit managers for them to have that conversation, they want to pick you to have the next conversation with and know that you're helping them on their education journey. And it's going to be more fruitful if they continue to talk to managers just to continue building out the palette, like understanding private credit. And then of all the managers, they do pick you to have that second follow-up conversation. So I think it's really important to have the patience, the commitment, the open-mindedness to understand you may have different levels of sophistication in front of you and to be able to unwind what you're saying or dial it back or ramp it up is going to be important. I was thinking about someone, the first time I met him was 6 months ago, and he was so green when we were talking about private credit. He does have the time to spend on it, and we'll talk about this, but he is not an advisor. So he's at an RA, but he's in the investment research role. So he's really digging in, but he didn't really know much in the beginning. We had a second follow-up. I'm glad he chose us. He had some repeat questions, which I was fine with, which is great. And then we kept progressing. We had a third follow-up, full on 60 minutes again, progressing. We had 2 more conversations with colleagues of mine to dive deeper in ESG and workouts. I mean, really giving him the whole full picture. And then finally, just a month ago, he's about ready to present to committee. And he was just so on. His questions were excellent. He was thinking around the corner. He was asking stuff that I talk about with my colleagues. And I was like, you really graduated. I felt so glad. So I think it really takes that patience, commitment, dedication to it, and know that it will take some time.
What's the hardest part about educating the wealth channel on private markets?
There's a few. I'd say not knowing what you're coming into is hard. That pop quiz kind of feeling is hard. So how to prepare for that as a specialist is you have to have your time to read up on everything that's going on in the space, your own portfolio, your own strategy, listening to an investment committee, the deals we're doing, the deals we're turning down, but also what's going on in the industry. There's a lot going on and being amplified in media that isn't necessarily perfectly relevant to our business. So demystifying that is really important. You have to have that at the ready. So you just have to constantly be on top of reading what's out there, what folks are saying in industry, and be able to have a thoughtful response or at least some explanation of how that relates or doesn't relate to your business. I think that's hard for folks. And so you have to really stay up on that. And then two, I'd say just really connecting is going to be important. That can be hard when the individual is really looking for education. And I'm a relationship type person. That's what I've done. So you can't spend half the time talking about each other's children. You really need to get to that part. So if you're only in there as an educator and then you're out, you're not necessarily supposed to be there to develop the relationship. So making the connection through true education, it's a unique skill set.
How much does structure matter in the context of education? And what I mean by that is you have the benefit of being affiliated with an insurance company in TIAA, and there are various iterations of insurance capital aiding private markets platforms. We could look at Apollo, KKR, and a number of others trying to create ways to give themselves structural advantage. Blue Owl's another one. Obviously, Churchill and TIAA is another. How much do you think structure matters, and how do you educate your clients on the virtues of structure?
So I think of structure in two ways, as you've outlined the question. The first is structure at the fund level, which is still a very big part of the education, and getting an allocator or an advisor comfortable with how do I even access this product. And that structure, typically when we're talking to the wealth side, for us has been through registered funds and understanding how our registered fund profile or wrapper differs from the others that are out there, because there are many that they can choose from, and what goes along with what we've decided to do, whether it's a perpetually non-traded BDC versus something as simple as an interval fund. They can look and feel similar. You've got managers doing private credit in both wrappers, but a number of differences. One chief among them is the fact that the redemption minimums are very different. Redemption maximum in a non-traded BDC is up to 5%, but an interval fund must at least offer 5% and can go up to 25%. So the makeup of the underlying funds can be dictated by your need to manage the cash or redemption risk. And you could see more diversified public-like type of securities in an interval fund than you would in a non-traded BDC. So there's some flexibility there. So I think education on structure really is important to understand what is an advisor, understand what are they coming into. But structure at the platform level is also pretty unique. We've spent time trying to have folks understand the benefits of a platform like Churchill, where we aren't just one BDC or a series of BDCs. We have a very diverse base of capital that comes across commingled drawdown funds, separately managed accounts, BDCs, a CLO complex, funds of one, and across this entire platform where the capital comes in very different ways, often seeded by our ultimate parent TIAA, which gives us the flexibility to even do these different types of fund structures, really allows us to achieve the scale that we were talking about earlier that gives us that advantage without overburdening any one fund with a concentrated position, because we will pursue that deal, $200, $300 million deal, and we will pro rata allocate it across all of these different funds so that no one fund has a sizable position that would feel like a $200 million size position is in one fund or two funds or three funds. It's spread across so many. So I think that structure and explaining the platform is such an interesting benefit that ties into the diversification that will help folks get comfortable with, oh, I see it, investing through a cycle, mitigating risk, diversification is key, and you're doing that and achieving it within portfolio construction, even at the investment level, and your platform makes sense.
What worries you most about private credit going forward?
I'd say what worries me most about private credit going forward is probably the massive amount of interest that it's created in terms of new entrants. I do welcome new managers coming to private credit. I do think it's good for the space to have more capital. I see it as a kind of an undercapitalized, massive amount of potential demand for private credit. If you think about the large, vast US economy, majority of which is driven by private companies, middle market companies, in the count of 200,000 or so, and only call it 5% of them maybe have private equity backing today. That's a massive white space of future private equity transactions that will need to be debt financed. That's what they're looking for. They're looking for private credit. And I think that amount of demand, we can't tackle it alone. So if new entrants come in, I'm welcoming that. But what concerns me is new entrants that maybe come in with structures that don't have the ability to have that diversification or don't have an origination capacity that's unique, where they will source what they can or go for the scraps that someone else doesn't want to do, and they will offer sun, moon, and stars to get the deal done because they have either lack of experience or want to be aggressive, or maybe even taking an opportunistic sort of approach to performing. And that could weigh on potentially defaults in the future or even show in the cracks of portfolios, non-accruals and whatnot, and see that rising. But I'd say my concern is that tainting the asset class altogether, where isolated managers maybe will run into these problems and it's a broad brush view of the whole thing is going down. And I don't think that's the case. I think it's going to be some managers more than others are going to be experiencing that level of concern in their portfolios. And the average is going to be fine. And then there's some that are going to be stellar, pristine, like zero non-accruals. So I do think spending time understanding manager selection and really what makes managers different is going to be critical. But that's my concern, is really kind of unnatural behavior, kind of taking a taint on the entire asset class and direct lending, and particularly being driven by headlines in the media.
Well, that also brings us back to education, which is then so important in terms of educating investors on the nuances and the differences between certain firms, the way that they conduct themselves, underwrite, manage risk, et cetera. So I think that's another piece of it. Related to that, how big do you think this market can get?
I know we were talking about size, and I know that there are industry veterans longer standing in this business than me that point to the 25, 30, 40 trillion dollars of size. And if we just looked at Preqin, I know they've got numbers out that are probably closer on the smaller end. Maybe it's the 2028, 3 trillion or so. So as small as, call it 4 or 5 trillion to as much as 40 trillion. Needless to say, I think it's going to continue to grow. Could it get to 40 trillion? Eventually, maybe it can. I think what's important to remember is what's going to drive that, and what side of that demand are you trying to find opportunity, and where do you feel the most confidence? And the biggest stakeholders in private credit are the borrowers and the investors. The borrowers here being those that are using private credit. And those are typically private equity firms. About 70, 80% of private credit is private equity backed. So that demand, what they're looking for, that slice of the pie, if you will, of middle market LBO activity has really just grown in terms of choosing a bank versus choosing a direct lender. I think we were at 36% of the market in 2014, and now we're 80, 90% of the market. So the slice of the pie has definitely grown. Market share has been taken, but the pie itself is also absolutely growing. And I think that push is really going to be driven on the other side of the stakeholder equation, which is the investor base. Institutions are already there. We've talked about that. There's actually institutions who haven't even touched private credit. So there's still some white space, but the massive amount of white space certainly is in wealth. And with their eyes on yield premium, diversification, low correlation, the current income component, attractive risk-adjusted returns, when you think about the loss history being far lower than what they experience in public loans and high-yield bonds, it really is still compelling. The argument to do it and not just sit is really big. So I think even seeing the growth through that is going to be tremendous. So I do think that this asset class has a lot of room to run. And that's why I don't feel so concerned about, is there too much capital chasing too few deals? Because I think both stakeholders want this. I think the borrowers want it, and I think the investors want it.
That's a great transition to the last question that I always ask every guest, which is, what is your favorite or most interesting alternative investment? I've tended to ask this looking backwards, but I think private markets are going through such an interesting time right now. I want to ask this question with a forward-looking lens of what do you think is going to be most interesting? Because you could have said private credit for the last 18 months and certainly would have made sense. You may say private credit going forward too, but what going forward is, in your mind, most interesting or your favorite alternative investment?
I love this question. I think looking ahead is always great. So what I think is really interesting and will continue to be interesting is the ability to offer investors exposure to secondaries. I say that because when you think about what's been happening with private equity and how long private equity firms right now in this moment have been holding on to great businesses, they've had a really tough time fundraising, as everyone generally has had. But even more so, they can't find a way to sell assets at the valuations they want to. And their hold periods have reached record highs. Historically, normal markets, their hold periods have been 3-4 years. And right now we're over 6 years before realizing anything for their LPs. That's a really tough place to be when you've already invested 60, 70, 80% of your current fund and you need to raise fund 4, your next fund, and none of your LPs have had the realizations they need to go back into your fund. That's a really tough place to be. But what's helping to unlock that is a massive, massive opportunity to provide a secondary option where some of your best assets, so GP-led, moving those into a different vehicle, getting some new liquidity for it, rolling some of your equity into that, but bringing in new LPs or new equity providers in a secondary fashion where a lot of the, not startup risk, but risk to grow has kind of been seen. And now you're coming in its second life and the inflection point that the private equity firm is still super excited about and they want to be involved in. And to get hold of that, it's an enormous opportunity, particularly where these hold periods are at and super undercapitalized today. There's not a lot of capital dedicated to secondaries. It's just at its early phase. So I do think that there's a massive opportunity in terms of pursuing that from the demand perspective and really bringing the supply to it. So return picture, very, very promising. It'll be PE-like in terms of what you're trying to get ultimately, de-risked a bit, given you've seen performance of the asset.
So interesting you bring up secondaries more in the private equity context than the credit context. So I'll touch on private equity for a minute, which is that private equity secondaries are booming. There's obviously massive amount of capital flowing into the space for all the reasons you say. Private credit secondaries are much more nascent, but given your background in credit, do you also think the private credit secondary space is interesting too?
I do. I do think the private credit secondary space could be really interesting. I think it's going to be a matter of what kind of credit you're picking up and how transferable is that credit. Because one part of me says, what I know and what I love about Churchill is that we are true direct lenders with a relationship on the line, and they know who we are and we know who they are, and we talk to the owner of the business, the private equity firm, constantly. If I were to readily sell a whole segment of my portfolio to a completely different lender, what does that do with my relationship? So I think it's different when it comes to direct lending from a secondaries perspective. But if it was private credit in the form of asset-based lending, when you maybe could be a little bit more removed from the direct relationship and originating that loan, and you're sort of bringing in a whole diverse group of collateral types in that, and chunks of that could be on the secondary. I think that could be a really interesting way to do it, but that's where I want to see, where does the relationship tie in, and would that affect the new owner in a positive way or a negative way, or is it neutral? So that's what I would think about. But yeah, I do think it's a pretty interesting place to go where I haven't seen a lot of activity yet.
And potentially only growing. But I think you've covered both the primary and secondary considerations of credit and the world of private markets today. Alona, this has been such a fascinating and fantastic conversation. Thanks so much for coming on the podcast.
Great. Thanks, Michael, for having me. I really appreciate it.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going